It is the most dangerous mathematical anomaly in modern America. While the news cycles focus on soaring stock markets and the promise of artificial intelligence, a silent, corrosive reality is eating away at the foundation of the American household. As we move through 2026, the middle class has reached a tipping point, a fatal systemic error that has transformed the credit card from a tool of convenience into a cage of survival. According to the latest 2026 figures, a staggering 29% of Americans now possess more debt on their credit cards than they have in their emergency savings accounts. Nearly 1 in 3 citizens is living in a state of negative liquidity. They aren't just living paycheck to paycheck, they are living on a high interest line of credit that is slowly tightening around their necks. Imagine a society where a single car repair, a failed water heater, or a $500 medical deductible is enough to trigger a total financial collapse. This is not a low-income problem anymore. This is a middle-class liquidation. In 2026, the margin of safety has been erased. Welcome to the ultimate fragility. Welcome to the Liquidity Death Spiral. The anatomy of the spiral. To understand why this is a systemic death sentence, we have to look at the cold, hard numbers. In 2026, the average credit card, APR, has calcified at an eye-watering 29%. At this level, debt is no longer a loan. It is a predatory parasite that consumes more energy than it provides. Let's look at the math. If you carry a balance of $5,000, a modest amount by today's standards, at a 29% interest rate, and you make only the minimum monthly payments, you will end up paying back nearly $15,000 over the next 2 decades. You are effectively paying for the same groceries, the same gasoline, and the same clothes 3 times over. The death spiral occurs when your emergency fund hits zero. In a healthy economy, your savings act as a buffer, a shock absorber for life's unexpected costs. But when that buffer is gone, the credit card becomes your only synthetic liquidity. When the car breaks down, you put it on the card. The interest grows. Next month, your disposable income is lower because the interest payment has increased, leaving you with even less money to cover basic needs. This is a feedback loop with no exit. The hollowing of the margin. How did the wealthiest nation in history reach a point where a third of its population is one flat tire away from ruin? To find the answer, we have to look at the hollowing of the margin. For decades, the American dream was built on the concept of surplus. After paying for housing, food, and taxes, the average family had a surplus that allowed for savings, investment, and psychological peace. But in the 2020s, a cost of living vacuum emerged. The explosion in the cost of the big 3, housing, insurance, and healthcare, has acted as a massive extraction machine. Wages have grown, but they haven't kept pace with the mandatory expenses of 2026. When your rent or mortgage consumes 40% of your income and your insurance premiums take another 15%, the margin disappears. When that margin goes, people turn to credit not for luxury, but for the basic maintenance of life. The psychological trap and fintech nudges. The liquidity death spiral is as much a psychological trap as it is a financial one. In 2026, the credit industry has moved beyond simple plastic cards. We are now in the era of invisible debt. Through buy now, pay later schemes and frictionless digital payments, the pain of spending has been completely removed. Algorithms now study your spending habits to offer you credit increases at the exact moment your bank balance drops. They have optimized the minimum payment to be a Tantalus trap, high enough to keep the bank profitable, but low enough to keep you from feeling the true weight of the principal you aren't paying down. This creates debt fatigue. When a person realizes they can never reach a zero balance, they stop trying. They begin to view the monthly interest payment as just another utility bill. Algorithmic predation. The liquidity death spiral of 2026 is not merely a result of bad luck, it is a masterpiece of engineering. Today, credit is an automated execution. Fintech companies have developed predatory nudges. They use your behavioral data, the time of day you shop, your GPS location, to offer credit increases at the exact moment your psychological resistance is lowest. If an algorithm sees you are at a grocery store and your primary account is low, it sends a push notification. This is the digital opiate. It feels like a lifeline, but it is a fishing hook. These companies have optimized the moment you cross the line from a transactor to a revolver. In 2026, you aren't just fighting your own impulses, you are fighting a multi-billion-dollar AI designed to keep you in debt until the day you die. Systemic fragility and the dry tinder. What happens when 30% of the workforce is one paycheck away from insolvency? It creates a systemic fragility that the financial markets are currently ignoring. In a traditional recession, a temporary downturn is painful but manageable. But in the 2026 economy, a recession is a mass extinction event for households. If unemployment ticks up by even 1%, the house of cards collapses. This is the banker's paradox. As defaults rise, banks protect themselves by cutting lines, lowering your credit limit as you pay it down. For a family using that credit to buy groceries, this is the equivalent of a life support machine being unplugged. The 29% debt to savings ratio is the dry tinder. The economy is the forest. We are currently playing with matches. The velocity of interest. We must discuss the velocity of interest. In a healthy economy, money has velocity. It moves and creates growth. But interest is the antimatter of money velocity. When you pay 29% interest, that money doesn't circulate. It is sucked out of your local community and deposited directly into the vaults of a few global megabanks. In 2026, the American worker spends Monday and Tuesday working for the credit card company, Wednesday for the taxman, and only Thursday and Friday for themselves. This is why the country feels poorer despite record corporate profits. The profit is the interest being harvested from your life force. The mathematical horizon. There is a point we call the mathematical horizon. This is the moment when your monthly interest payment exceeds your monthly surplus income. Once you cross this horizon, you can no longer budget your way out. You are in a state of terminal debt. No amount of cutting back on coffee or subscriptions will save you. At this point, you are no longer a participant in capitalism. You are a debt slave. In 2026, more households are crossing this horizon than at any point since the Great Depression. The death of the escape hatch. Historically, Americans had two escape hatches from debt, bankruptcy and home equity. In 2026, both have been compromised. With home prices at record highs and inventory at 20 million unit lows, the starter home no longer exists. You cannot refinance your way out of credit card debt because you own nothing but the clothes on your back. Furthermore, you may be too poor to go bankrupt. To hire a lawyer for bankruptcy, you need cash. If you have zero savings and your credit is maxed out, you are stuck in a financial no man's land, unable to pay but unable to legally stop paying. This is the permanent underclass of the 21st century. The inherited spiral debt is hereditary, not through law, but through environment. Children. Growing up in the zero savings households of 2026 are not learning the mechanics of wealth. They are learning the mechanics of survival. They see a world where everything is a subscription, where nothing is truly owned. This is the normalization of the abyss. When an entire generation grows up believing that 29% interest is just how things are, the very concept of financial independence dies. Chapter 10, The End of Social Mobility. Wealth isn't built by how much you earn, it's built by how much you keep. When 29% of your income is lost to interest, you lose the power of compounding in reverse. While the top 10% see wealth compound through assets, the bottom 30% see negative wealth compound through interest. In 2026, the American dream has been replaced by a subscription to life. You don't own your future labor. You have already sold it to the credit card company to pay for the steak you ate 6 months ago. This is the birth of the permanent renter state. Act accordingly. The 29% credit card trap is not a mistake. It is the business model. Your liquidity is their revenue. Your stress is their yield. If you are part of that 29%, realize that the time for business as usual is over. You are in a financial war of attrition. Breaking the spiral requires a radical rejection of the credit culture of 2026. Check your ratio, look at your margin. The spiral is spinning, and it only gets faster the longer you stay inside. Act accordingly.